All right. Well, hello, everybody. Thank you for joining us here today. I am grateful that everybody is on the call. What we're going to be talking about is this is our first iteration of the 27T charted series. So, the goal of our presentation here today is to provide you with some visual representation around what's going on in the economy to help you better understand what we're looking at from an economic perspective, as well as what to expect looking into the future. And so I am going to go ahead and share my presentation with you all today. And specifically, what we're going to be talking about is the state of the US economy and what are the key insights and trends that we're seeing here today. So I think before we even jump into what's been happening as far as the data goes, I think most people today are a little uncertain on where we stand. Some people are very excited about the future. Some people are very nervous about the future. And I think what we'll show here today through these charts is one, the economy is on good standing. It's standing on good feet, and there's a lot of data to back that up. Two, a lot of the uncertainty that we've been feeling over the last 6 to 8 months is starting to play itself out. And I think that will be a positive as we look forward to 2025 and into 2026 as it pertains to the US economy. So overall, how is the US economy performing? When we're talking about economic performance, whenever you're thinking about, okay, I saw this data point on CNBC or I read this in the Wall Street Journal, more often than not, what people are talking about when it comes to economic performance is GDP or gross domestic production. And what we're looking at here is not necessarily, hey, if there's a change quarter to quarter, we need to start being concerned. Overall, what we want to focus on is the trend. And what we're seeing from Q1 of 2022 through Q1 of 2025 is an overall positive growth trend. This is something that is a good thing, but also has been bolstered by some inflation. But I think as we go through the rest of the data points here today, what we're going to show is there's really some positive overall performance as it pertains to that as well. So I think what we're seeing today is some normalization as it pertains to the annualized GDP numbers. You do see Q1 of 2025 in the negative. In my opinion, a lot of that stems from the uncertainty of the tariffs. A lot of businesses holding off on making large decisions until they better understood what to expect from a macroeconomic perspective. And we're expecting to see here in Q2, as the numbers play themselves out, what that will look like moving on through the end of the year. So this number, we pulled the data as of June. So we've had some new numbers come out, but really what we're looking at is the Atlanta Fed GDP Now forecast. So this is taking a look at all of the future looking indicators and trying to determine what to expect moving forward. We're expecting some positive growth moving into Q2, Q3, and Q4 for this year. And if you combine Q1 and Q2, overall positive growth numbers, that if we didn't have some of the shocks in the system that we did, you'd likely see 2 quarters of positive numbers here. Recessions. So this is the question that comes up every conversation I have with somebody that's concerned about the economy. There have been 35 recessions since 1854. So a ton of economic data, ton of economic history here. And really, I show this as a point to say recessions are a natural recurring part of history. And really what this comes down to, what you need to be thinking about is, do I have the right plan in place to weather this? I think it's nearly impossible to correctly call one, let alone the multiple recessions that you'll see throughout your career and throughout your life. So, what are you doing to make sure that you're set up for both the good times and the bad? Think about your investment structure. Think about your cash that you keep on hand, your emergency savings. Those components will help create some comfort as you go through some uncertain times from an economic perspective. But I don't expect that to be happening this year or even looking into early next year either. And another point that I want to show here is if you look at the far left hand of the column, you'll see that those recessions happened far closer together. Really, I think this is twofold. One, we were such a manufacturing focused economy dating back to the 1850s and through the 1930s. Those tend to be far more cyclical industries where you have a lot of positive and negative growth, and that creates more regular occurrences of recessions. As we look on the right hand of the column, you tend to see larger gaps in between when those recessions occur. Personally, I have a theory right now that overall market cycles are going to move even quicker than they ever have been before. That is because of the extreme shift in the US economy to being more of a service producing economy. It's much easier for businesses to adjust those services quickly than it would be a manufacturing cycle. And then two, the speed at which changes can be made and data is exchanged is going to create these really quick moving market type of environments. And so that's what we saw here early in the year. We saw some of the most significant down days in 2025. It's hard to believe that that already happened earlier this year, and we're already looking at positive numbers for 2025, but we were down almost 20% close of business. We were down actually over 20%, which is an indicator of a bear market, while the year was, or at the beginning of the year. And I think that's just such a fascinating component of being an investor today. I think you have to start getting used to the speed at which these markets are going to move. So again, tying back to the decisions that you're making as an investor, think about, is my asset allocation set up for me where I know I'm going to be comfortable if I see these dramatic moves in the market? Some people are comfortable with taking on more risk to get that growth. Some people need more stability. Really, the best laid plan is something that you can stick to during times of chaos. And so making sure that you fine tune that asset allocation component is an important part of what your investment philosophy should be. Now, continuing to look at the historical growth of the US economy, I know there's been a lot of talks around US exceptionalism. Do we still expect the US to be a leading economy moving into the future? I don't really think that there's a need to spend a ton of time on this because I think the answer is yes. I think that if you look at, despite recessions, the economy has grown more than 6x since 1970. It really shows the power of long-term compounding of the US economy, as well as the structure of, though you may or may not like where government is today, but the core structure of our government allows to have such a strong business focus here in the US and creates this cycle here that's really positive from a growth perspective. And I expect that growth to continue. It will look different at different times, but overall, looking back, this is 75 years of data roughly. Recessions happen, market uncertainty happens, the US economy takes it in stride, adjusts, and moves forward. So now zeroing in on what's going on today, what's going on in the economy right now. And what we want to look at is the labor force. And so the next couple of slides are going to be focused on this and this, really the overall strength of the US labor market today. What we're looking at is a change in non-farm payrolls month to month, as well as a 3-month moving average in the green. So the yellow is just simply looking at the month-to-month data. The green line there is a 3-month moving average that's really meant to smooth out that data for you and give you a better understanding of the key trends of the labor force versus some months are bigger months than others, and there are a number of different factors that play in there. Really, as an investor, as somebody that's looking at the economy, the trend is what's important here. And so, really, job creation continues to hold strong. And with months averaging over 140,000 new jobs, all of that shows that the labor market remains a pillar of strength here in the US economy. Job losses in the United States, initial claims continue to be an important factor of what we look at. The fact that they're remaining below 250,000 is indicating limited layoffs. The economy isn't signaling any major distress. Given labor is such an important factor of economic production, this is a very important signal for us. Again, we're focused more on the trend than the immediate results. But we also need to understand that job loss and labor numbers will be one of the lagging indicators that we're looking at. We know that those will be one of the last numbers to turn over before we see some sort of economic pullback. Or oftentimes what happens is the economic pullback happens before the labor numbers change. Really, what we want to see here is that continued positive trend line, and something that we're seeing dating back to 1970 is we're in line with those averages, and that's a positive sign. Same thing with continuing unemployment claims. This usually is a longer trending component because they're folks that are struggling to find work, and so they continue to file unemployment versus initially filing for unemployment. Overall, it remains healthy, and those claims remain low, suggesting reemployment remains steady. Folks that are losing jobs are finding the ability to find new jobs. So there's not a lot of time in between someone losing and finding a new job. All of that is positive as it pertains to the labor market health. And then the unemployment rate, what we see here is the unemployment rate continues to chug along at a healthy clip. So there's obviously the extremes that we saw coming out of COVID-19 or COVID in 2020. And given that we're back at unemployment rate of 4.2%, that's right around historical averages. We're far from really any crisis territory as it pertains to the unemployment rate. It has trended up a little bit, but healthy employment rates can vary considerably, anywhere from the mid to low 3% all the way up to 5 or 6% is something that is not necessarily concerning. Now, if we saw it go from 4.2 to 6.2 in the matter of a few months, that might be something to look at or be concerned about. But if it's slowly moving up due to significant changes in technology, there is the potential that that rate of change won't impact the overall health of the US economy. Job openings in the US, and what we're showing here is there's just about 7 million job openings today. Labor demand remains high. Businesses are still looking to hire. We're off of the peaks coming out of COVID. That is not something that's surprising to me. I think you'll hear this probably 100 more times. If you're putting a quarter in the bucket, trend should be the word that you're focused on, because we're looking at the trend here. And where we see the outliers is coming out of 2020. From a hiring perspective, it just created a lot of chaos. And so what I'm seeing here by looking at this chart is we're seeing a return to normal. Normal is a good thing from a labor perspective. And for any of the business owners out there that know, If you can forecast further into the future, you're more comfortable making big decisions. And that overall is a positive sign. And the fact that labor is not taking up a considerable amount of concern for businesses today creates a positive growth environment. And then lastly, as it pertains to labor in the market, looking at quits versus hires in the US economy, though the number of quits remains elevated, this is showing workers are still confident they can find better opportunities. Overall, I don't think that this is anywhere near what we saw coming out of 2020, where employees actually had the power where when it came to determining salary and uh, businesses being in a very hard position to hire. I think we've seen a transition back to the business having a lot of power as it pertains to finding and attracting the right talent and not having as much turnover as we were seeing just for, let's call it 2 to 4 years ago. That again is another positive indication that the economy is in a good spot. Without that significant turnover, without employees changing jobs every 5 to 6 months, again, businesses can plan better into the future. There's less uncertainty, and all of that creates a better environment for businesses. So looking at retail sales, another key component of the economy, and what we're showing here is the month-to-month changes of retail sales as a percentage. Overall, consumers continue to spend, but they are showing some signs of caution, and we've seen some recent pullbacks. I think this is an area that I'll continue to watch closely, but I do look at the data and I say, hey, start of the year does tend to be lower in terms of overall spending. We saw a significant jump in March. I think that that had a lot to do with the tariff announcement and businesses pulling forward a lot of spending that likely would have been, or I mean, individuals pulling forward spending that likely would have been happening over April and May due to the fears that things were going to get more expensive. Overall, the trend line has been trending down, but still remains in positive territory. Overall, I think this is a soft but not concerning data point. I think that as we look towards the end of the year, especially around the holidays, where you tend to see higher overall spending, things will play itself out in a positive manner. Looking at the federal funds rate, what do we see here? Really, what we're showing is where we are today as far as the effective federal funds rate goes, 4.33%, as well as the projections of where it will go over the next 2 years, down to about 3.1%. Really, overall rates are probably going to be remaining elevated relative to what we've experienced over the last decade, uh, given that markets were showing really almost zero borrowing costs since the great financial crisis until right around COVID. We really haven't been in an environment that we had to deal with interest rates much at all. I think there's a couple of things to keep in mind here. The first is we've been through higher rates for some time now, and the economy has continued to chug along. I don't think that it's necessarily going to be a significant deterrent unless we see a shock reversal in the sense that the interest rates get risen in the near term versus reduced. Another component here, this is just a personal anecdote. I don't think that we're going to see any immediate relief in terms of reducing interest rates. Why is that? Well, there's a long-standing tension between the presidency and the Federal Reserve. And the Federal Reserve is its own body, its own governing entity, and it's not supposed to be influenced by the president or any function of the executive branch. And so really what's happening is there is pressure that's being put on Fed Chair Jerome Powell. And in my opinion, what I think will happen is there's probably going to be posturing uh, moving forward from the Fed president. And I don't think that he wants to show that he can be bullied. Obviously, regardless of how you feel about that, this is just my opinion on the psychological component of the two entities that are battling it out right now. So, what that means is uh, there's call to lower interest rates. I don't think that it would overheat the economy today. I don't think that it would be a bad thing. I think overall it would probably help spur some kick some things loose and get some activity going. But I think because of the public fight that we're seeing between the president and the Fed chair, there's likely going to be a hesitancy to lower rates because it would show that the pressure mounted and created that rate lowering. And I don't think that anybody wants that on the Fed chair side to feel like he's bending to the president's desire. And so overall, I think that's going to remain pretty static here moving into the end of the year, but I don't expect it to have a negative impact on the economy. Monthly wage growth overall, we're looking at steady but moderate wage growth, about 30 to 40 basis points month over month. Overall, this is a sign that the wage growth component of the economy is cooling, but not collapsing. And overall, we're looking to see inflation move closer to the Fed target of about 2%. And that creates a healthy environment for businesses. I think this is a positive sign that there are still opportunities for wage growth, but it's not something that businesses are having to shell out significant increases in annual compensation to try and keep people in the seats that they're in. It's creating a better business environment today versus what we saw just a couple of years ago. Same thing. So this is taking a wider scope view, looking at yearly wage growth in the United States. Year over year, wage growth is up about 3.8%, 3.87% to be specific. Inflation, what this is showing is one, inflation is normalizing, but two, there's also real earnings gains. So overall, people are earning more relative to inflation. I think that's a positive thing overall. Though what I'm going to show you in the next slide, most people are not feeling that. And what we're seeing here is feelings about the US economy. This is the University of Michigan Consumer Sentiment Index. This is one of the longest standing sentiment indicators that we've seen. And it's a survey that's asking the general population how they feel about their financial picture and the economy. Overall, sentiment remains low. And really, we're seeing wage growth is something that has actually been positive. It's not being realized by the end consumer. I think that has a couple of things going against it today, the sentiment indicator specifically. So the first being there's so much conversation about inflation and how expensive things are. It's going to take a long time from a perception standpoint for people to realize that their income is in a better place than it was a few years ago because things are just more expensive. It goes back to the loss fallacy principle in the sense that you feel losses more. You feel when you spend more than when you're making more. And I think that's going to work against people's positive feelings in the market. Two, I think an interesting component of what we're seeing, not just in the University of Michigan sentiment indicators, but in really most surveys of sentiment across the US, is things are being very polarized as it comes to politics. So you tend to have significantly different readings of sentiment when a Republican is in office versus when a Democrat is in office. And depending upon what side of the aisle you prefer, that drives a significant output of your overall response rate to this survey. And I think from my perspective, these types of surveys are going to factor in less and less in terms of a leading indicator for me. This is something that I want to focus on the trends. And if we see levels get to the high 100s, like we saw in 1998, or in the late 80s, those are types of environments where the market is overheated, and we tend to have over exuberance in the market that can lead to needing to have some excess pulled out of the market through a recession and correction. But in terms of the monthly, even quarterly, and sometimes even annual results of these sentiment indicators, I think that number today is a bit cloudy due to the impact that polarization is playing in these sentiment surveys today. Now, getting to inflation, I think this is something that we had touched on briefly, but I think it's such an important component as we move forward here. What we're seeing is things are starting to normalize, and I think that's a positive. Headline inflation is at 2.8%, core inflation at 2.4%, and trending down. And this is getting closer and closer to that Fed target. So looking at these two readings, what is headline, what is core? Headline is going to take into effect all a huge basket of goods, and then the core is going to subtract out the more volatile, think energy, grocery type of costs that can fluctuate considerably in short periods of time. Both of these indicators are trending in the right direction, and I think are overall positive as both from an individual and business perspective. Consumption as well. So this is looking at personal consumption expenditures. Again, both headline and core, similar factors there in terms of the difference in reading. And really what we're seeing here, this is the Fed's preferred inflation gauge, and we continue to see moderation here. And again, I think this is another sign that the tightening cycle from the Fed's perspective is working. And also there's just simply less dollars in the market sloshing around. So inflation is coming back down to where we want it to be from a longer term perspective. And I think that's an overall positive indicator for the future of the US economy. Another chart here, this is the producer price index. So this is looking at wholesale inflation. We're now at 3% from a core indicator and 2.6% from a headline indicator. Really, this is another great data point that we're showing that's saying, hey, inflation is easing. We're not there yet, but things are getting better. And I think that trend line continues to show we're moving in the right direction. And this is the last chart that we want to show today, and focus primarily on expected inflation in the US, looking at both the 5-year and 10-year break-even inflation rates. Markets are expecting 2.3% inflation over the next 5 to 10 years, and that's very close to the Fed's target. A component that I personally look at is the difference between the two, 5 and 10 year. What you see, it's 2 basis points. There's a very little difference there between the 5-year and the 10-year. Why is that important? Well, to me, what I see is if you're able to plan out not just 5, but 10 years into the future from an inflation expectation standpoint as a business, it creates more confidence in your ability to forecast and make those decisions to positively impact your business, and maybe take on some of those larger investments that you were putting off during the uncertain times following the tariff announcement and the uncertainty that the COVID crisis happened. So really what we wanted to show here today is there is uncertainty in the market, and we're still working through some of that. But in reality, if you look at the trend line through every chart that we showed you here today, is though it's not perfect, it's moving in the direction we would hope it would move. And I think that's such an important aspect of what we've got here in the US economy today. It's not perfect. It's not something that everybody is having a fantastic experience with. But overall, as an investor, I think that this is the right time to be looking at investing in the market, taking advantage from a business owner perspective of the different projects that might have been put off. Where can you make an impact there? And I think this is something that as we look to the back half of 2025, we'll continue to see the market move in a positive direction. So that is going to conclude my prepared remarks today. I did want to leave time this afternoon to answer any questions. So what we've got down at the bottom, you should see a question and answer tab at the bottom of your Zoom. If anybody has any questions as it pertains to the economy, investing, etc., type them into the Q&A, and I would love to answer those questions. I'll give people a few minutes to put questions into the box if you have any. I did want to, while we wait for those to come in, want to let everybody on the call here know, one, you will be receiving a recording of this following the meeting here today. Two, if you like this chart series, please let me know. We're going to continue to lean on the visual representation of what's going on in the economy and try and paint some pictures that will provide a good understanding of what's happening and different ways to look at what's going on in the world. So it's something I'm excited about. We're continuing to expand our offering here, and I think that there's an opportunity to get a lot of good information from this series. So keep an eye out for future ones that will be coming out here shortly. Well, it doesn't look like we have any questions here today. I want to thank everybody for taking the time over lunch to hop on this call. And I want to thank you all for being valued clients of 27T Financial. Again, our goal here is to help make you an informed investor, and we want to give you the tools and resources to do that. So any questions that you have, anything that you need from me, everyone, please reach out, send me an email, give me a phone call. I'm here to help. Thank you for the time, everybody.